Live on YouTube. Alrighty, welcome guys. This is going to be the HaiKhuu options class. It's going to be a little bit more of a beginner class. I want to talk a little bit about everything, especially for a lot of the new guys that maybe are pretty new to trading and all that. But yeah, essentially, we're going to be talking about, of course, options strategies and my favorite one. And then we're going to be talking about how to combine that with technical analysis and fundamental analysis, essentially. So yeah, let's get into this. Oh, hold on. There we go. So the first thing we'll go over is actually the actual option strategy. This is the most important part, I think. Technical and fundamental analysis are also very important when picking the stock and choosing when to open it. But your actual strategy, understanding how options work, in my opinion, is the most important thing. So my strategy that I like to use pretty much is probably my favorite one is cash secured puts and also covered calls, which is very similar to the cash secured put. And a cash secured put is a safer way to buy shares pretty much, like, because you're essentially, instead of just buying 100 shares at the current price, when you're selling a put, someone actually pays you to buy the shares at a lower price than what it's currently trading at, which is the put buyer. It's like selling insurance to people that own the stock. You can think of it as like car insurance. People, funds that own like millions of shares of stock. It's worth it to them to maybe buy a put to protect to the downside. And even if that put loses and goes to zero, they're going to still make a ton of money on the stock. But we're selling them insurance because sometimes you need it, and it's just worth it for people to buy puts. So that's why selling puts works. Is there's always going to be a demand for insurance. So what is a cash secured put again? I'll go in a little more detail. Again, it gives you the obligation to buy 100 shares of a stock at a price that you get to pick. You want to pick a price that it's lower trading at, that's lower than what it's trading at currently. And so you're going to receive a premium, it's called, for accepting the obligation to buy the shares. And in order to open the trade, a cash secured put, you're going to need at least enough funds to purchase 100 shares at your strike price. That way, if it goes below, you're going to have to buy 100 shares. So you'll need the cash to do that set aside. Your broker require that. And then, so yeah, if the stock stays above your strike price and it doesn't go below, then you just make income. You don't have to buy the shares and you get all your cash back. All right. But if it falls below your strike price, then you're going to be forced to buy the shares and you still get to keep the premium, though, which is the best part. You're always going to keep the income. Okay. And a lot of new traders, they're always, trying to buy calls or buy puts. Um, so I'm just going to go over the difference because they're both ways to go long on a stock, specifically with 100 shares. But with selling puts, you have a high probability of winning because you want the option to go to zero, and options have theta decay. And especially if you're selling puts that are below the current price of the stock, I mean, you're just improving your chance of winning the trade overall. It does have limited profit potential when you sell a put. The most money you can make is the price of the put that you sell. So if the put's worth $1, and you sell that put, the most you can make is $1 per share or $100. And again, you benefit from theta decay, which is time passing. So as time goes on, options get cheaper. Therefore, it's in your best interest to short these options because they naturally go down in price. So yeah, and then buying calls, instead of high probability, it's a low probability of winning. But in exchange, there's always a gimme and a gotcha with options. Like you have unlimited profit potential when buying options, but in exchange for that, you're not going to win that many of your trades at the same time. The benefit of this though is you don't need enough money in your account to buy 100 shares, so it's less capital intensive. But again, you're going to lose most of the time, mainly because of theta decay. which again is just literally time going on. And as we know, as time goes on, options get cheaper because that's just the way it works. There's less extrinsic value, it's called, because options are priced with intrinsic and extrinsic value, and extrinsic value is just time premium. So if you're selling options, you're basically just collecting time premium as your strategy. Okay. So like I've been saying, selling options wins. It's also statistically backed. You can look up back tests of option selling strategies, and it just works in the long run. The odds are in your favor, and all that. So when you sell puts, another benefit is that the worst case, you're just assigned 100 shares of stock that you can literally hold for the rest of your life. But if you buy a call and the stock maybe moves a little bit or just goes down, doesn't really move a lot, like your calls aren't going to go up just because of theta. Like in order to win on a call, the stock has to move up a lot in like a short period of time. But when you buy calls, it can literally go to zero and you won't end up owning shares. You'll just lose all your money. So at least when you sell puts, there's a little bit of a backup plan. And I will say there are certain benefits to buying options. I do this mainly only if I buy put options to hedge the puts that I sell, right? So let's go over this example on this Apple I drew up real quick. If you sold $100 put on Apple and agreed to buy 100 shares at $100, you could actually hedge this by buying the $90 put on Apple with the same expiration date, right? So essentially, you're selling the 100 put. Let's just say you collect $100, and then the $90 put costs you $50. So your net credit that you're gaining is 50 cents, $50. So even if that 90 put expires and goes to zero, you're still going to make money because the $100 put paid you $100, right? And that's called a put credit spread. So the only time I buy options, pretty much, is if they are forced to buy options that I've sold already. If that makes sense. So like you sell $100 put, collect $100, then that means you can spend, maybe $25, $10, $15 on a call or a put to buy just in case Apple dips. And the benefit is that you're kind of in a way winning on both sides because you're winning if Apple stays above 100, and then with the put you can also win if Apple drops low, and you'll get a sign, but you'll have the put to hedge that you can sell for a little bit of profit with these spreads, right? So that's I'll leave that there for options. We're going to go over probably some trade examples after, but just for some basic other knowledge about picking stocks to trade options on, let's get into that. First thing I'm going to go over is just pretty basic fundamental analysis, because you only want to sell puts on stocks that you wouldn't mind holding forever, of course. And to determine if a stock is worth holding forever, you should definitely look at the fundamentals of the stock, right? So this is where learning how to read financial statements comes in, such as the income statement, the balance sheet, cash flow statements. We'll go over an example. I think I have a couple examples here. Yeah, so just like you don't need to be like a master with numbers to, do a fundamental analysis. The basics that you want to see on the income statement that you can see here, one is revenue growth. So the very top, you see net revenue on this Corsair Gaming income statement. It increased in 20. So you have 2 years. This can also be quarterly. This is a yearly. You have 2020 and 2021. And on the right side on 2020, the revenue is about 308,518. That's probably a million or whatever. And then 2021, it went up about 200,000, which is revenue growth, right? So that's a good sign. If the company you're investing in is making more money every year, that means more and more people are finding value in the company, of course, and giving them their money. And then next is positive net income. So even though a company's revenue is growing, it doesn't mean they're actually profitable. They're making money, which is great, but net income will tell you after taxes and all cost of goods sold if they're actually making a profit. And in this case, you can see the net income line is the blue. Probably a little hard to see, but in 2020 it was 1,200, and then 2021 is 46,000. So that's insanely good um, net income, and that's also net income growth as well. But as long as that's positive, that's how you know a company is actually making money. And then EPS is earnings per share. This is basically you get that by dividing the company's revenue by the amount of shares outstanding. And yeah, of course, a higher EPS means they're making more. Their earnings per share is better, and it's always good to see that increase as well, just like the revenue and all that. So that's all I'm really going to go over. Oh, and also, if the EPS is negative, that means right off the bat, you know they're not profitable. If And also if the PE ratio is negative or the EPS is negative, you know right away that company has negative net income, which is fine. Like if their revenue is growing, sometimes it's not the worst. And then we'll go over the balance sheet basics. So here you'll see a company's assets and liabilities. Basics, you want, of course, more assets than liabilities. And then under the assets, you can see how much cash the company has. And it's a good thing if the company has more cash than they do debt, which debt's under the liabilities. So that's a good thing to compare. And increasing shareholder. So the shareholder equity is your total assets minus your total liabilities. So this can be a quick way to check, one, to see if you have more assets than liabilities, and see if your assets are growing and your liabilities are shrinking. So the shareholder equity increasing is a great sign because it means that the company's either acquiring more assets or taking on less liabilities, which is pretty just good for the company. That's basics there of fundamentals. So once you find, and if you're just trading companies like Apple or Microsoft, I mean, yeah, everyone knows Apple makes money. You don't really have to go too in depth with it. And so now that you have, you know how to find good stocks that you want to hold, and the option strategy with high probability of winning, which is selling puts. Now you want to look at the charts, do some technical analysis. So yeah, once you have I would build a watch list of, just go through 10, 15 companies that you like, blue chips preferably, probably, if you want to be safe. Make sure they're profitable, you like their business model, and then you want to look at the charts. So of course the idea is to buy low and sell high when trading, of course. So what we do though is we'll sell a put. So if you want to sell puts when the stock is low, because if a stock is already trading low, then if you sell a put to agree to buy it lower, then you're really increasing your chance of winning here by a lot. So yeah, so when a company when a good fundamentally strong company starts selling off, I mean that's a great time to sell a put. And you can also use indicators to find support levels and whatnot. My favorite one that I've been using is volume profile. So I think I have a couple slides on this too. Yeah. So volume profile, I have some pictures that I'll show you. Oops. Sec. But so normal volume bars, I'm sure everybody here has seen. It's on pretty much every stock chart. They're vertical, and it shows. So since they're vertical, it shows you the volume per time period. So if you're looking at a 5-minute chart and you see a lot of volume, like a big volume bar, that means within that 5-minute period, there's a lot of volume traded. But and the volume profile, on the other hand, is horizontal. So it's going to be on the, the right-hand side and sticking out horizontal. And so this will show volume per each price level, which is way more important because you want to see where people are buying and selling, not just when, because that doesn't really tell you much. Like, yeah, you can, after, if someone's buying a bunch of Apple at the market closes, that's cool, but it's way more important to know which price they're finding value in the stock at. right? And so the volume profile will show you a value area, which is where the most volume is traded. And then it'll also show you something called the volume point of control, which is where the most volume was traded on a specific stock. And it's important to know that price will generally always kind of revert to areas of value, which is the areas of value are the points with the most volume. And so, yeah, let's go over the key terms. The VPOC, or the volume point of control, is the price level with where the most volume is traded. There's a couple different ways on the volume profile. There's an intraday point of control, which shows you where the most volume just for one day was traded. And then there's also, you can set up the volume profile to show you the most volume traded for a specific amount of days, which means like the past year, you can see where the most volume was traded. And yeah, that's the volume point of control. It's indicated by a red bar. I'll show you on the next. Yeah, so just to give you a little preview, this is Apple on the 1 year, 1 day chart. And this is, so on the right side, that's the volume profile. You see the red bar, it's at about 123. That means the past year, the most volume on Apple has been at 123. So that's where people essentially are finding value in this stock, the most value the past year or so, right? So, and again, the value area is where 70% of the volume is transacted. So on here, the volume area is 135 to 110. So 70% of the volume the last year in Apple was traded in between 135 and 110. So that's called the value area. Right here, Apple is pretty symmetrical, so the VPOC is right in the middle, but sometimes the VPOC can be lower on the volume area, or higher on the value area, not volume. And then, yeah, so, and I also recommend, if so, this is like the past year, this is intraday. So now you see a red bar, the volume point of control, every single day. So this is more for short-term traders. But yeah, so basically every day, you can think of it, if you guys know what the VWAP is, that's kind of what the red bar is. It's just where most people have bought the stock throughout the day. And all these lines can be support and or resistance. And the stock price generally likes to return to this price at the red bar, essentially. And what I do, I combine them both, right? So now I have the volume profile, the point of controls every day. And then on the right side, I have overall volume for the past however many days. Yeah, and Spec is talking about the VPOC. He's saying it's the fairest price to do business, which is correct. No, yeah, Spec, if you want, you can chime in. I know Spec has taught me a lot about this volume profile and the market profile. But I think it's cool on this where you can combine both of them.
Yeah. So sorry to interrupt. No. So you can think of the VPOC, the volume point of control, as the fairest price to do business, because that's where most of the shares or contracts have been, exchanged, transacted at that current price. Because, and another way to look at it is, okay, let's just say we have a consolidation type of day, and the VPOC is right in the middle of the range, right? So you can say below the VPOC is considered undervalued intraday, and above it is considered overvalued. Because the idea is, if the market was to find value higher, the VPOC would continue migrating higher, because people are willing to bid it up higher, right? So you could say opposite for a trend down day, or like a pretty heavy sell day, you will see the VPOC actually migrating lower, because people are finding value lower, because nobody wants to buy at the highs currently because of some, I don't know, they perceive the market as too overvalued at the current price. So you'll see the VPOC migrating lower throughout the day, and that shows that people are finding value lower, and people are selling tons of shares to buyers lower, if that makes any sense.
Yeah, so yeah, that's a good thing too because the VPOC, I mean, it's going to move. It's not a static thing. Like as the stocks keeps trading, the volume, the red bar where the most volume is traded can easily move, right? So if it starts at the top of, if it's very high at the start of the day, and then by the end of the day, the VPOC moved all the way to the bottom of the range, that's a pretty bearish sign because that means people are finding value in that stock lower than they were previously. So, yeah, it's important to know. There's a lot of nuances to it. I'm still, I've been using this for, maybe 6 months now. I think it's really reliable for support and resistance lines. And then like mean reversion, like if it gets like Spec was saying, if the price gets too far below the VPOC, and maybe it hits the previous day's VPOC, and there's a good chance that it'll act like a support, and it can eventually go up after that. Right.
An important nuance to look at. Let's just say, the VPOC is the current day's VPOC is higher than the current price, and it's selling off currently, right? And it hits the previous day's VPOC.
Yeah.
What you would want to watch is how we transact at the lows, right? So if we gain a lot of volume and acceptance at the lows, that's a very bad sign. If time is spent and a lot of volume is transacting at the lows, that's a sign that okay, perhaps the market is finding value lower. So I should be very careful on the long side because this thing could really, really get ugly.
Definitely.
Now, if the volume gets very light and we reject that nuanced area, the previous VPOC, and we spend very little time, very little volume is transacted there, then you could say that, this is most likely going to bounce off this area and it should go back to VPOC.
Yeah. So actually, let me pull up some charts here.
Just to clarify, just to clarify something, the bars on the right is a summary of all the bars on the left, correct?
Yeah. So this summary here is basically just all the volume traded within the last however many days on your chart. So in this chart here, this only has 4 days. So this here is the past 4 days. This VPOC is where the most volume. This VPOC on the right is where the most volume has been traded on SoFi in existence since it's only 4 days old. SoFi is not really the best example to use. Let's go to something that's a little more, established. So on Apple, you see the last 10 days. You see the VPOC's different every day. But this one is where the most volume for the last 10 days was traded. Yes, on the right side. And then
the summary of everything on the left.
Yeah, so these ones on the left, this is just for the 1 day.
Gotcha.
So 1 day, and then this on the right is all the days on your chart. So you can make this as long as you want. Like we can go 5 years. Past 5 years on Apple, it's been the most heavily volume place is $42. On past 1 year, it's actually right here where the price is, about 123. So that's actually pretty good. And it's good when VPOC, especially when this one lines up with these. So like you see this VPOC lines up with all this price up here. That kind of shows you that that's a pretty good line. In this case, it would pretty much be resistance since it's above the current price, which is right here. Right. And then, so let's look at combining this with options now. So you see Apple on the daily, the most volume trade is right here. It's actually bouncing off pretty much this support line right here. So, I mean, you could say if you sometimes it's easy to just drawing a couple lines on the chart, finding the range. So obviously Apple, the bottom of the recent range is about here. The top of the range is pretty much like here. Somewhere right there. So obviously, if you just do that, you would want to sell put options when Apple gets down to 116, 115, even here. And then after you sell puts there and Apple goes up, then you can either take profit here, or if you have shares, you'd want to sell covered calls when Apple gets up here towards the top at like 137, right? So you really just got to find the range, find the supports. You see this volume profile. I mean, you can go on all these different lines, and you see if you go back to 90 days, I actually like this here because you see the red VPOC on the right here is a lot higher. And remember, the price will naturally like to return to the areas of value. So since the VPOC, you see it's at like towards the top of the range here, there's a good chance. And also look at this. The VPOC today was super high in the range. That means we're pretty bullish on Apple right now, because if the VPOC was like all the way down here, then that means like the price started here, and as it went up here, not that many people were transacting at the top, but since the VPOC is, at the high of the day, that means wow, a lot of people are finding value in Apple higher and higher. It could continue up. So, and then I use always 30. If you're gonna look at the intraday, I always use 30 minutes because that's what the guy that created this indicator pretty much used, is always 30 minutes. For this right one, all that matters is the days. So this is 90 days, and then you can go back to the last 30 days, and their VPOC for the last 30 days is here, and then 10 days last VPOC. So they're all pretty much at 126. So that's pretty significant at 126 there. On that volume, and then here it's 134, right? And then on the right side here, there's actually, so let's see if we can find a nice. So I think ES has a nice gap, or like SPY. So look at this this is a volume gap. I don't know, can you guys, let me see if I can draw something right here. Oops. Right there, that's a volume gap. So if we go back, it's actually even on the daily. Let me turn this second one off so you can see the candles better. Lower this. So this gap right here on this day, you see this gap right here, it caused this volume gap. So that means almost nobody owns SPY of like 402. So basically, where there's areas with low volume, it can shoot through this area really quickly because the price of the stock likes to go to areas of high volume. Okay, so if you can see the highest volume on the daily is down here, and you can kind of like pick and look at the high volume areas. Sometimes it's more obvious, like see on like stock like this, like obviously you see there's high volume here at 572, and then the next high volume node they're called is at 3, and then the next lowest one is 1.6 there. So that's where most people find value in these stocks, is where the high volume is. And so you basically want to, let's see if you can find a good one. When the volume starts fading off and starts getting lower, that's kind of when you'd want to start buying. And you can use like the top yellow line and the bottom yellow line as support and resistance again. So essentially, like the trades I'm in right now, let's see. Let's maybe use pins. I'm actually an Apple too. But you see pins, the range. You can draw these two price levels. Low end of the range is down there. High end of the range is up here. I sold puts towards the bottom the other day. Whoops. Sorry, I have all these lines on the chart. These are previous day VPOCs. But I also used this 200 SMA line. I was like, this looks like there's decent support there. You see the volume fades off here where it bounced. So that's a really good place to go long when you see the volume starts fading off. There's a good chance it'll turn back here. And so that's essentially why I chose to sell a put on pins. Went to the trade tab, went to 16th of July, and I sold this 52.5 strike on pins the other day. Okay, and I collected $61. And so the 52.5 is about right here on the chart. 52.5 right there. So I agreed to buy the stock at a place that it hasn't been for a while. since this gap right here. So as long as pins, the stock stays above this line at the bottom here, I'm gonna make money every
just
day
nothing special.
due to the theta decay. Pins, the stock stays above this line at the bottom here, I'm gonna make money. Okay, and then yeah, so as long as the 52.5 or this pins stock stays above my strike price, and each day the put I sold will pretty much decrease in value each day. And that's pretty much the goal of selling puts. I mean, you can, so the closer to the stock price you get, like I can even agree to buy this at 62.5, right? So that would give me a lot more premium, but it's a less chance of winning, right? So that's pretty much my option strategy. You know, on Apple, I sold a 115 strike put, which is towards the bottom of the range here again. Always sell the puts at the bottom of the range. You know, you want to buy this, agree to buy the stock low, and then if anything, sell it high. So that's what, and you always, yeah, you just basically, it's pretty easy, guys. Like you just sell puts at value areas where there's support. Worst case, you'll end up owning the shares and you just hold it and then eventually sell covered calls. Or you can just continually roll these puts, which means you buy it back and then sell it at a further date. And just, I just keep collecting premium. I don't like to own the shares. So I'd rather just, I do own shares, but I mainly sell puts with most of my money. So yeah, you can see here, I have the 115 put. And that's a 14 delta, which means I have about an 86% chance of winning that. And yeah, you can actually customize this to see whatever you want. Like delta, that's your percent chance of losing actually. So if it's a 14 delta, is a 14% chance of losing, therefore 86% chance of winning. So I mean, there's trades that technically have 99% chance of winning if you go to a 1 delta and sell that. And yeah, this is SoFi. On SoFi, I'm short a few puts. You know, I have 2 of these 17 halves. And again, if you see the chart of SoFi, yeah, the lowest it's gone is 20. So I'm selling puts below 20. So this stock has never even, well, IPOE has been below 20, but SoFi, since it's traded, has not hit that area yet. And so worst case, SoFi goes below my strikes. I have 17 and a halves on the weekly, and then I have some monthlies. The 17 and a half, I have the 15 and the 12 and a halves. So yeah, that's pretty much this. Each put I sell, I'm agreeing to buy 100 shares at the strike price. And in exchange for that, you can see the money I'm getting. It's 17 half. I can get paid about $115 just to agree to buy SoFi at 17 and a half, right? So if it goes to 15, I'll have to buy it at 100 shares at 17 and a half, and I'll still collect the $115. So, and then after that, you own the shares. You can just hold them because it's a great company to hold long term. Or you can just come over to the left side here and you own it 17 and a half, and you can agree to sell it at 25. And same thing, you sell the $25 covered call, you get paid $125 again in premium, bringing your total premium collected up to like 250. So now you own at 17 half, you've collected 100, so you really own it at 16. And then you get a sign and you sell the covered call for $125. That brings your cost basis down another. So now your real cost base is like 15. And worst case, if with this covered call, is that you might have to sell your shares at 25 if it goes to like 30. So you'll miss out on some profit potentially, but at least you're collecting income still. So you pretty much end up winning at the end of the day regardless, right? So yeah, and obviously implied volatility plays a pretty big role in options because stocks like Apple, not as many people buy puts on Apple as they would a new company like SoFi. So in exchange for taking on more risk with a smaller company, you're going to get paid more premium for the amount of money you put up. Because look, I'm collecting $109 for putting up $17.50 in SoFi. And Apple, not quite as volatile, quite the opposite. I mean, I put up 11 grand and you collect $85. It's a hell of a lot safer, but it just requires more capital and you get less premium for it. But I'm personally pretty conservative, so I don't mind that. Um, collecting less premium for less risk. So that's completely fine with me. But there are some, like SoFi. Yeah, I would say have an even mix of both. Like you want some small companies and you want some bigger companies. It's good to diversify. So I've CSPs on Corsair, Apple, Pins, Palantir, Clove. Like Clove is only, Clove is a good example of a really small one that you can use. You know, for only putting up $700, you can make. I collected $40, and 40 divided by 700, that is a 5.7% return, which is going to be a lot better than your $85 and 11K on Apple, which is zero point 0, like barely 1% return, right? So that's why I like to mix both. And the more capital you have, the easier it is to trade options, because then you can just go to like stocks like Amazon or SPY. Even like SPY is like an index. Like you can just hold this forever pretty much. And you can put up this money, collect, couple $100 every week. You just have to have the capital to do it. To buy 100 shares of SPY, it's 40 grand. But if you have a $200,000 account, you can sell a bunch of puts on SPY each week out of the money, and you'll collect some income. And worst case, you'll end up having to buy SPY at whatever price you sell the puts at. So yeah, on SPY, I mean, you would probably want to sell a put. The further down you go, the safer it is. I would say, and it depends on the premium and how far you go out. Yeah, I personally like to go out to like 30 to 45 days for my contracts. But trading weeklies is completely fine as well. It kind of depends on the stock. Like something like SoFi, sometimes the weeklies are like something that's done in 2 weeks instead of 42 days. You can get paid more sometimes, just because there's less time and the volatility is pretty high. On stocks like SoFi, I see it's over like 100% there. So yeah, that's why I decided to sell a couple 17 and a halves, because I already have, these 42 days out. And my plan is, now that I've sold these, eventually once they go down in price, I'll buy them back and roll them out to the same thing in the next date. So actually, I can roll this to the next date here and collect another $74, basically just for increasing the amount of time on the contract. So every like week or two, all you have to do is roll them, collect more money, and you're good, right? So yeah, that's pretty much. Does anyone have any questions or anything? It looks like 12 might have one. So how does this work in smaller accounts if I don't have enough cash for 100 shares? And don't do naked options. Should we just wait and do smaller companies, or do the spreads, or both? So it's kind of tricky. I always recommend so the smaller your account is, the more risk you're gonna naturally take on. Because on Apple, yeah, if you do a spread, let's say you sell the 120 and buy the 115, like since you bought the 115, you're only going to need $500 for this trade, as you can see there, 430. That's because you're hedging it, like kind of what I went over earlier, and that's fine. You can do these spreads in a small account. Just keep in mind, if Apple dumps and goes to like $100 and you can't accept assignment, I mean, you just got to be ready to take the whole loss, because I mean, you can try to roll it, but eventually you can get assigned and then you'll just be forced to close out for a loss. So honestly, it's way easier to trade this with, at least 10K. But if you can, it's fine to find some smaller companies like SoFi or Palantir, PLTR, and or even like Ford. With since it's cheaper to buy 100 shares of those stocks. So that's yeah. You get I with spreads. I don't like doing the spreads in smaller accounts, just because if it goes in the money, you can't roll or accept assignment. So you kind of end up just screwed, right? So as long as you're okay with taking more risk, then yeah, you can do that in smaller accounts. But just know one trade can wipe out lots of winners in this strategy, and that's the benefit of being able to take assignment, is that you can hold the stock until it recovers, and you don't just have to close out for a loss. Yeah, so I'm like house and sin on, so I do equity and covered calls. Are if you already own shares, then yeah, covered calls are great, because if you already have 100 shares of anything, you don't need a single extra dollar to sell a covered call. You actually need less money because you're collecting premium. So if you already own a bunch of shares of something and you don't mind, like Spec has a bunch of shares of Palantir. We were talking about this before the close. Um, we're telling them, I mean, he has 1,000 shares. You can go ahead, go to the options and sell a way out the money covered call if you wanted. Like, maybe was it SoFi? Yeah, on SoFi, there's actually a 50 strike. That's so far out of the money. Like, this thing would have to move up over 100% in the next month and a half for this to trade to lose, right? So you can sell a 50 call. And remember, if you own 100 shares, it doesn't take a single extra penny to do this. So, like, in the worst cases, that you have to sell your shares at $50 a share and then collect a free $20. So it's a really, really high probability strategy. Covered calls and cash secured puts, it's a very good strategy. And then another thing you can do is a strangle. We have something called a HaiKhuu strangle, which is when you sell a cash secured put, you own 100 shares and you're also selling a covered call. So a strangle is pretty much here when you sell a put and you sell a call at the same time. So this basically means that you're agreeing to buy your shares lower, and then you're also agreeing to sell your current 100 shares at a higher price, and both obligations, the put and the call, are paying you extra money just to accept these obligations, right? So it's another good strategy, is a strangle. And yeah, is there any other questions? I can easily go over pretty much anything you guys want to see. Yeah, no problem, 12. If anyone has anything to chime in, go ahead. I've actually already been at this for 50 minutes. That went pretty quick. Yeah, this is my watch list. Oh, and actually, I have if you guys would be interested, I've made a CSP scanner. You can make a watch list and you can tell it to scan in that watch list. I have this CSP watch list, and then basically I want to at least, I put it a 1% return on risk at least, and I wanted at least, I set this usually higher, like at least 10% out of the money, which means if the stock drops 10%, then I'm just barely breaking even. And yeah, that's pretty much it. 1 to 60 days to go. And yeah, so if you can see, I sort this by percent out of the money. So this SoFi, so the SoFi 12.5 put, it's 65% out of the money. So if SoFi drops, if I sold this put today at 12.5, and SoFi would have to drop literally 65%. And after it does that, I would just be at my break even point. I wouldn't even be losing yet. I would literally be breaking even if SoFi drops 65%. And so that's why I like to use the percent out of the money. So I sort them by percent out of the money, and then I look for the one that's the most expensive here, because you want to get also a good premium, because the ones that are far out the money, like this one's only $20. So you want the ones that are far out the money, have a good return on the risk, and have a decent premium that you're going to collect. So this one here, this SoFi put came up. This one's really good. It's 37% on the money, 3.5% return on risk. So you're making $50 and you're 37% out the money. A couple of questions. Could you review NYMT? That New York Mortgage Trust. Yeah, I don't know what this is, but it looks like it's in a pretty nice uptrend. I'd have to look at the fundamentals of this. I'm not sure what you wanted to know about it, but let's see if there's any options. Yeah, you can't really trade options on this at all. Yeah, not every stock has options, guys, so you never know. And KChow, where draw those trend lines and pins. What trend line? Let's see. Oh, you're just talking about. I was just drawing. Basically, it was just a basic where I see the trading range. So if you just delete these lines, I mean, all you have to do is, all right, where's the top of the trading range and where's the bottom of the trading range, right? So you go, all I did was I found the bottom here. I drew a line. This is pretty basic. And then I found the top of the range and I drew a line. So that, I mean, it's just as easy as that. And it's better to do that. Sometimes like the stocks aren't as range bound. Usually stocks are pretty cyclical and are range bound, but something like an index like SPY, it's kind of hard to do that on. It has been going straight up in this insane bull market that we've been having. Hit all-time highs again today. Looks like. Oh no, not quite. It's right there. But yeah, how do you trade options? Okay. Yeah, so like I was saying, the way I trade is I sell puts, KwaZulu. So when I'm trading, the way I trade options is kind of like a mix of buying equity and combine. You can't trade options on NFT. They're just not liquid. Like, yeah, there's literally, you can't even sell a put on this. Like no one's bidding on it. So unfortunately, you cannot. Yeah, it's gonna I mean you can, but I would not recommend it, because if you buy one of these options, there's literally not a single person that's willing to buy it right now. So you got that. You guys got another important thing about options too is honestly liquidity. On Robinhood, it's kind of not good because it doesn't show you the bid price and the ask price. But if you look on TD, you can see this bid price and ask, like it's 0 and then 50. So if you bought this at the ask for 50, that's the price you can buy at. You can't even sell it for for 1 penny. On Robinhood, it's going to show you the mid price at 25. This option isn't, I mean, you'll probably, if you bought this option, you could probably buy it for $25 maybe. But the problem is no one's going to you can't sell it to anyone. So that's why liquidity is important. You got to look at the most important way to find liquidity. Yeah, the delta and volume, or the open interest and volume, is good, but as you can see, this one has decent open interest, but there's no bid and ask, so you can't trade it on there. Yeah, no bids exactly. So sometimes it can be a little misleading on Robinhood, and then the KChow threw me off because the range you drew had a previous high above the range. Previous high, I don't know, was it Apple? Maybe it was Apple KChow. I mean, it's not like I wasn't going, super in depth about this, but the range, I
Oh yeah, I think it was Apple.
What's up?
Yeah, I think it is Apple.
Yeah. I mean, it like it hit up there once, but it's only red candles up there. Pretty clear resistance, so I just drew it at the point where it reacted to it. So because I saw it reacted more times.
More support.
Yeah, because here the stock's only been there once. So, but here it's been there, it's been there, and it's been there. So the more times a stock reacts against a certain price level, the more, um, the more you can trust that price level, I guess. That's it there.
What about the bottom?
Yeah. Oh, NDX was up 1.7. Probably good on today.
Very informative.
Thank you. I hope you guys learned something, at least one thing. Yeah, it's pretty brutal day for SoFi and Corsair today, but look at this. I mean, so I have about 90 shares of Corsair right now. I actually luckily sold 25 of my 100 yesterday and bought some more today. But you see my equity on SoFi and Corsair is down, lost me $31 on theoretically 500 shares. So you can see, even on a minus 8% day, I'm literally only down $31 on I think five CSPs. So that's what the benefit of selling out the money puts does for you. It's just less volatile because yeah, your P&L is going to move as if you own 100 shares at the strike price. So, I mean, obviously, if you own at $12.50, and the stock's at 20, it's not going to affect you that very much. And Clove, I sold a CSP. I think Clove is up today. And yeah, Corsair is down 54 on my CSP today. The stock itself is down 6%. My shares are down 148. So I'm down. So I actually have 100 shares technically with a 30 put, and then I guess 90 shares Corsair, and the CSP I sold is only down 50. The equity's down 148. Given my profit is capped on the CSP, but there's a lot higher chance that I'm going to make that money, and even if Corsair doesn't move, I'm still making money, which is the benefit of CSPs over CSPs over equity. Because equity, I mean, my average on Corsair is like 33, and for me to ever make money on Corsair, it has to go over like 34. With my CSPs, it just has to not go below 30. So pretty good stuff there. Selling puts. And then, yeah, worst case, you sell a put, you end up with the shares anyway. And then you can just sell calls or sell more puts. And the idea is that the more premium you sell, the more your base is going to go lower and lower and lower. So instead of I really don't own Corsair at 33. I've collected some premium. So I own it technically. It doesn't say here because it's separate on Thinkorswim, but my trade price is probably a lot lower than it actually says. But yeah. So I think we're probably called a day. Any last minute questions?
Nope.
Well, cool.
Nope.
So yeah, I think we'll probably call it a day on this one. Thanks for attending, guys. I hope you guys learned a thing or two.
Thank you.
So yeah, it's about 2, so I guess we'll call it a day.